In this video, you are going to learn how to get funded quickly. So let's start. The need for an edge. So basically, to succeed with prop firms and earn money, you need an edge that can be replicated flawlessly. Believe it or not, an edge isn't just a random strategy that you pick up from a YouTuber with titles like I made 5K with this strategy. This is the only technical analysis video that you will ever need. I made my life savings with this system. All these kind of titles. So then trying to implement it with real money without testing can lead to disaster. Your edge should be structured as a set of rules, creating a mechanical system. Let's look at how to create a mechanical system that gives you that edge. Here is the process. First, create a system that you believe has an edge. It could be anything from the classic break and retest, trend lines, trend line breakouts, supply and demand, or any other strategy. The key is to backtest it with sufficient data to confirm it has an edge and can produce positive expectancy over time. Now, the execution of the edge. So, developing a system is the only first step. To succeed, you must execute it consistently in a live environment. Let's discuss how that works. Once you have an edge, edge means a mechanical rule-based system with positive expectancy. All you need to do is execute it live to make consistent profits. I won't dive deep into how to create an edge or the factors to consider when creating one, as this video solely focuses on how to get funded quickly. So let's assume you have a mechanical trading system with an edge. Now, the next question is, how should a profitable trader approach funding challenges? There are two approaches. One is aggressive approach and the other is conservative approach. Let us discuss about both of them. So let's say you are consistently profitable and you have a $2,000 of capital. So 2000. Now you have two ways. You can either approach aggressively towards prop firms, prop firm challenges, or conservatively. There are two approaches, either aggressive or conservative. So let us discuss about the system statistics first. System stats. Suppose your system generates maximum DD of -8% historically and produces average monthly return of 5%. So to pass phase one and phase two, in phase one you have to make 8%. In phase two you have to make 5%. So together you have to make 13%. Means with 5% on an average monthly return, if you, it takes around 3 months, nearly 3 months to pass phase one and phase two. So it is very huge time. So how you can pass quickly? So you have to take more risk per trade. So these returns are when we take 1% risk per trade, right? These statistics are when we take 1% risk per trade. You have to increase risk, like you have to take risk like 2%, 3% per trade. So but you cannot increase more risk blindly, because because of the drawdown limits we have, your challenge accounts can be blown if you increase the risk when the drawdown phase hits. So how you should approach? So there are two ways, either aggressive or conservative. Let us discuss the two ways. Let us discuss about aggressive way first. So with $2,000 capital you can buy 500K accounts or 850K accounts. Given that, let us say 100K costs around $500, means with 2000 you can buy 500K. 50K costs $250. 50K costs $250. So 850K accounts. So 500K accounts means, let us say you are taking 2% risk per trade to pass quickly. So suppose the maximum drawdown of the system historically is -8%. So if you incur a maximum drawdown, whenever you start your challenge, obviously you won't incur more loss than -8%. But as you are taking 2% risk per trade, we have only 10% maximum drawdown in our prop firm challenge. So if you go to 5% of maximum drawdown, obviously it hits -10% of your drawdown limit, because you are taking 2% per trade, not 1%. So if you drawdown goes to 5%, then obviously here it will be 10%. So you lose the account. But what you should do here is, even though you lose one account, you have to buy another new account immediately and execute the same plan with same risk. So already here you have hit 5% of the already 5% of the drawdown here. So in the worst case, how much drawdown, how much more drawdown you can get? 3%. So because your maximum drawdown is -8%. So 3%, same 2% risk. So if you start new account, you hardly go to a drawdown of 6%. But if you keep on taking 2% risk per trade, obviously your drawdown will be capped. So then you will start, then you will start getting wins, so that your equity will go up. So finally you will pass this account, you will pass this second account. But you have sacrificed one account for that. See, all this is during the worst case scenario. I'm not saying that you will definitely fail one account if you increase the risk. No, during the good time you can even pass the first account itself, or two accounts in a row as well. It can happen. So but we have to consider the worst case scenario. We should be able to handle the worst case scenario if you want to pass quickly. And the same approach can be, let us say, the same approach you can follow by taking 3% risk per trade as well, 4% risk per trade as well. But all depends, whether to take this much risk or not depends on how much backup capital you have. If you are willing to sacrifice two accounts, three accounts to pass one account quickly, like in 1 week or 2 weeks, you should be able to sacrifice multiple accounts based on your system statistics and how much percentage of risk you are taking. This is the example. If you want, let us say, if you want to take 3% risk per trade, with 3% risk per trade, just imagine 3% drawdown will generate 9% drawdown in your funded challenge. So you lose the challenge, because as we have only 10%, right? Let us say you lose the challenge. So immediately another 3%, let us say another 3% you have got when you buy the next challenge, same risk rules, same risk per trade, 3%. Then also you lose the second challenge as well. But third challenge, you pass quickly, because you are taking 3% risk per trade. Got it? And once you reach funded stage, even just on 100K, even just 2%, let us say 2% profit on 100K will generate you $2,000 after profit split. $2,000. So this $2,000 will recover everything. That $2,000 of profit recovers all the money that you have spent on failed challenges, on sacrificing accounts to pass one account, one challenge quickly. So that is how all the professional traders, whoever are trading, taking big payouts, are approaching the challenges. So it all depends on how much capital you have. So you can do that, because let us say you want to do the same thing with 50K accounts. Here you have 850K accounts with whatever $2,000 capital you have, right? 850K accounts. So you can easily take 3% to 4% risk per trade to pass, even though you blow multiple accounts, because if you hit, when you hit a drawdown, but still you pass one account. So then in live account, what you do? In live account, you just simply reduce the risk to 1%. You don't take, just remember, you don't take 2%, 3% risk per trade in live account. You only take 1% risk per trade in live account. Got it? So whatever in live account, whatever money you make is a real money. So you will receive real money. So obviously, just one payout can recover everything easily. So that is how you should approach the funding challenges. So this is the aggressive method. Uh, Now let us discuss about the conservative method. So conservative method, let us say you have very less amount of money. So this method is for those people who have very minimum capital. Let us say you have just only $500. And these two methods are specifically for those who are consistently profitable. These are not for those who are not yet profitable. I'm talking about, I'm keeping, I hope you are profitable trader. I'm assuming that. So let us say you are profitable, consistently profitable. You have only $500. So you can take a conservative method as well. Let us say you have only $500. So you bought only 100K account with whatever the money you have. You don't have anything else. Now you have to stay consistent. Your system's maximum drawdown is 8%. Unfortunately, if you started your account, let us say this is the equity curve, let us say this is the top and this is the maximum drawdown phase of 8%. Let us, unfortunately, you have started your account here, then also you won't lose your account because you take only 1% risk per trade. You are taking only 1% risk per trade. This is the conservative approach. But ultimately, if you stay consistent, even though you won't lose this account, you won't lose the account during this drawdown phase. Ultimately, your drawdown will cap somewhere here, and you will ultimately make profits and you will recover everything. And ultimately, you will pass phase one and phase two. Then you will go to live account. Got it? So based on your system statistics, based on your system statistics, based on the capital you have to either choose one of these approaches. I hope you got it. So this is how all the professional traders are approaching. I know few persons who even take 5% risk per trade because they have huge backup capital. They won't mind losing a couple of accounts, three, four, five accounts in a row. Then they hit the drawdown phase. But one account, if they pass, then they just take consistent payouts from that account. All they do is just they reduce the risk to 1%. So there is a 0% risk of ruin here. 0% risk of ruin here. If you take 1% risk per trade in funded accounts. So even just, yeah, all you have to target is just 2%, 3% per month in a funded account, live funded account. So this is how you should approach. And these are the two types of risks, two types of approaches that we have: aggressive and conservative. How large payouts are achieved. So now you might wonder how some traders manage to achieve those massive payouts we often see online. Let us uncover the truth behind their success. They often take an aggressive approach. They leverage the advantage of backup capital to handle multiple failed challenges before succeeding. So once they funded, they reduce risk to the minimize. They reduce risk to the level which minimizes the chance of account loss. It's not that these traders have necessarily have the best systems. They have the freedom to take risks and sufficient backup capital. They won't show the failed accounts. They only show the successful payouts and past challenges uh, to attract clicks or sell courses. Why some traders getting banned from prop firms? While large payouts may look glamorous, it's not. It's important to understand what prop firms expect from traders in the long run. Some traders with substantial funds take the same aggressive risks even in live accounts as well, risking 4 to 5% per trade, like that. While they may lose accounts, they can quickly buy new ones and keep trading aggressively because they have backup capital. However, this behavior leads to bans from the prop firms, as this is very risky for the firm. As firms prefer traders who act professionally and aim for consistent monthly returns around 3 to 4%, the firms always supports those traders. So, what are the key takeaways? What are the key takeaways? Uh, Prop firms always welcome professional traders who aim for consistent, moderate returns. You can adapt an aggressive approach in the challenge phase, but once the account reaches live, reduce risk to a level where your system's drawdowns won't blow your funded account. Thanks for watching the video. If you think this video has provided value to you and your trading, make sure you hit the like button and subscribe to the channel. Thank you so much for watching.